Hello everyone, welcome to this video where we're going to be looking at Chapter 7 from our Financial Management course, BUS 223. This chapter focuses on the topic of valuing stock. So we're going to be looking at, we'll start with looking at what stocks are, what do they represent. We will review some of the key terminologies when it comes to investing in stocks, and then we'll move on to cover some of the most commonly used techniques that are used in order to value stocks. So let's begin. Now, first of all, let's try to remember what stocks represent. Stocks represent a share of ownership in a business, on a publicly available company or publicly traded company. You can buy a stock, and that purchase of that stock would represent the you actually acquiring a portion of the ownership of that company. Okay. Now, if you remember, we talked about the role of a financial manager, and one of the key roles that a financial manager plays is or the decisions that he makes is acquiring funds to fund the business activities. And those funds can be acquired in multiple ways. One of those ways are by selling a portion of the ownership of that business or offering a portion of the ownership of that business to investors who buy this ownership and become partners in the business. That procedure is done through what is called an initial public offering. Okay, what's an initial public offering? It's the first offering of a stock to the general public. Okay, so a company decides that they need some funding for the business, and they determine that the best way to acquire those funds is by selling a portion of the ownership of the business. So they arrange with the stock exchange, the stock exchange in that country, and also in coordination with a specific bank that underwrites the whole operation, and they offer those shares to interested investors who then buy those shares. They buy those shares in what's called a primary market, which is the market for the sale of newly issued securities is carried out. Okay. Now, as opposed to a primary market, we have what is called a secondary market. Now, if I acquire, or if I buy some stocks through an initial public offering, the money that I pay to purchase those stocks, to acquire those stocks, goes to the company that issued the stocks. But then I can, a while later, maybe decide to sell those stocks to another investor, and that happens in what is called a secondary market, where the funds flows from that new investor to me as a current holder of the stock. So the company doesn't get any of the proceeds from the sale of that stock in that scenario. Okay. Stocks also come in different forms. The one that we are mainly interested in for the purpose of this course is, or for this topic, is what's called a common stock. Okay, a common stock is an ownership share in a publicly held corporation. As we said, that represents a slice of the ownership of that business. Okay. Now, acquiring stocks typically comes with some benefits. Those benefits include dividends. Now, what are dividends? Dividends are periodic cash distributions from the firm to the shareholders. So the company runs through their activity and they make profits, right? And then those profits, the company would make a decision to either keep all of the profits. Some companies do that. They don't give back any of the profits they achieve back to their investors. But typically, most companies, they'll take their profits and they will split them into two parts. Some of the profits will go to the investors in the form of dividends, okay? And some of the profits would be used to fund future investments of the business, right? In the form of what's called retained earnings. Okay, that will be really important later on in this chapter, but it's worth mentioning right now. Now, this is the part that we are talking about right here, which is the portion of the profits that is distributed back to the investors in the form of dividends, which forms a portion or a part of the profit that the investor would actually, or the returns that the investor will generate from investing in that company. Okay? All right. Then we also want to remember PE ratio. Now, what is PE ratio? PE ratio is simply price to earnings ratio. This is a ratio of the stock price to the earnings per share. Okay. Now, the PE ratio is very important because it is used as a simple tool that represents like a measuring stock to compare different companies or different stocks. We can quickly determine if the stock is relatively overvalued or undervalued. Okay, a high PE ratio would mean that the stock's price is expensive relative to its earning and possibly overvalued. Okay, and vice versa, of course. So if the price of the stock is relatively low compared to the earnings expected or earned per share, that would indicate that stock is undervalued and possibly it might be an attractive investment opportunity for investors. Okay. Now here we have this example for FedEx, the very well-known company, and as we can see here, this is from the stock exchange, from NASDAQ. The screenshot shows a lot of important details about the stock. We can see the previous close of the stock at 161.50. We can see the opening price. We can see the bid price and the ask price. I'll get back to that shortly. Very important. We can see 1 year target estimate, the price expected for the stock within 1 year or in 1 year. And then we have beta, which we don't cover within the scope of this course, but it's also another very important indicator that shows the relationship or the correlation coefficient between the stock itself and a market portfolio, so the whole market. Okay, and it's typically a number around 1, so it could be just a little bit lower than 1 or just over 1 normally for most stocks. And then we have the next earning date. We have the day's range, so the stock price within the trading day, the lowest price and the highest price. We do have a 50-week range that represents the range of the stock price within the last 52 weeks, so within the past year. And then we have volume. We have average volume over 3 months. And then we have the market cap or the market capitalization of the company, 45 billion. And then we have the PE ratio for the stock. Okay, we have earnings per share, $3.80. And finally, we have the dividend and the dividend yield. So $1 dividend and the dividend yield is 0.65%. Okay, now let's go back to the bid and ask prices. What does the bid price represent? It represents the maximum price that a buyer is willing to pay for a share of stock or another security. So in the case of FedEx here, this is the highest price that is offered by a potential investor to buy the company's stocks. Okay? Whereas the ask price represents the minimum price that a seller is willing to take for that, or to be willing to sell that security. So it's someone who already owns the stock and he's offering his stocks or his shares to be sold, and the ask price would be listed for the seller that is offering to sell their shares for the lowest possible price. Okay? And normally, even in the example here, as you can see, normally there would be a gap between the bid and ask price. Okay? And that gap, or that difference, in this case here we have like around 7 cents difference. That is called the bid-ask spread, which is the difference between the highest price that a buyer is willing to pay for the stock and the lowest price that a seller is willing to accept in order to sell his shares. Okay. Then we have different types of orders. When you trade in a stock exchange, you would see different kinds of orders that you can place either to buy or sell shares. Those can be either market orders or limit orders. Now, for market orders, these are orders to buy or sell shares at the best currently available market price. So when you enter your broker's account and you want to buy, let's say, FedEx, okay, stock, you would be given a choice between having a market order or a limit order. If you place a market order, the broker would try to complete the transaction to fulfill your order with the best possible price. Okay? But this kind of order is unconditional. You're not going to be able to set the price that you desire. Unlike a limit order is an order to buy or sell shares at a predetermined price to be executed when the market price reaches the requested price. Okay? So, for example, I could place a limit buy order for FedEx stock, let's say at $155. Okay? If I do that, most likely the order will not be fulfilled because the current price of the stock is $160.39. But if the stock price goes down a little bit and the broker can manage to find someone who's willing to sell their shares for this price, it will fulfill my order. If not, the order will not be fulfilled and it could expire. Okay? Here's an example. If an investor wishes to purchase 100 shares of FedEx with a bid price of $159.78 and an ask price of $159.99, how much could the investor expect to pay for the shares? And what is the PE ratio and dividend yield? Okay. Now, if the investor wants to buy 100 shares, okay, and he places an order to buy 100 shares, the price that the order will be fulfilled at is most likely going to be the asking price, which is the price that someone who already has the shares and he's willing to sell them at this price. So this is the price that they are asking for. Okay, so the 100 shares will be executed at $159.99. Okay, so how much would the investor pay in that scenario? 100 shares multiplied by $159.99, that would be $15,999. All right. Now here, the second part of the question says, what is the PE ratio? As we said, the PE ratio stands for the price divided by the earnings per share. And if we go back to the previous slide, we can see that the price is currently at $160.39, and the earnings per share are right here at $3.80. Okay, so that means the PE ratio for FedEx is going to be $160.39 divided by $3.80. And this is how we have calculated the PE ratio right here at 42.25 times. Okay. What does that mean? That means for every $1 of earnings that FedEx generates, if you buy the stock at the current price level, you would be paying 42.25 times the earnings that the stock is generating per share. Okay, that's why this is called a multiple, أو بالعربي نسميه مكرر ربحية. All right, it represents how many times the price is represents or as a percentage of the earnings per share. And finally, the third part of the question says, what is the dividend yield for the stock? Again, we can go back and find the dividends, the annual dividends paid by the stock right here at $1. Okay, and they already calculated the yield here. It's given, but if we want to calculate it, we'll take the dividend in a dollar amount and divide it by the stock price. So $1 divided by 160.39. Okay, and that will give us the dividend yield for FedEx stock. Okay. Now here we have this chart that shows the share price history for FedEx. Okay, and just by the chart we can actually extrapolate a lot of very important information about the stock. Okay, we could see, for example, the current price of the stock. Okay, we could see the range that the stock has moved in the past or over the period that the chart covers. For example, since April 2015, or this chart is at least showing from April 2015 to November 2015. We could see the highest price over that period. So we can see the range that the stock has moved within. Okay, we can see the highest price that the stock have achieved over the period. We could see, for example, the lowest price. Right? We can see trends in the stock movements. The stock is going up or down over a specific period of time, and so on. So all of these details can be seen or can be extracted from a share price chart like this. All right, so it's very useful for investors to get the hang of using these charts and extracting information from it. Okay, now we'll talk a little bit about the difference between a firm's actual market value and its liquidation or book value is attributable to its going concern value. Now, what are the factors that affect the company's going concern? Their earning power. So the higher the company's earning power, typically the bigger the gap is going to be between its market value and its book value. Their possession of intangible assets, brand names, patents, copyrights, and things like that. And also the value of future investments. So the bigger the future investment plans, typically that would increase the market value of the company and will increase the gap or the difference between the company's market value and its book value. Okay. What is the book value? The book value is the net worth of the firm according to its balance sheet, and it's basically the difference between the total assets of the business and the total liabilities of the business, whereas the liquidation value or the market value is the net proceeds that could be realized by selling the firm's assets and paying off all of its creditors. Okay. And based on that, some companies like to use what is called a market value balance sheet. This is a special type of balance sheet. You've learned in your financial accounting course about the balance sheet. And one of the important things that you've learned that on a company's balance sheet, the company is required to record their assets based on their actual costs. This is called the costs principle, if you remember from your introduction to financial accounting 1. And this is one of the principles that are required by GAAP, the generally accepted accounting principles. Okay? Whereas a market value balance sheet, the company records their assets and their liabilities based on their market value, not their actual costs. Okay? So this specific statement is non-GAAP statement. Okay? So the company cannot produce this statement and release it to the public. That would be a violation of GAAP. Okay? But they can use this internally for internal purposes. All right? So it's a statement or financial statement that uses market value of all assets and liabilities on that statement, unlike the actual or the GAAP balance sheet, where the company is required to record their assets and liabilities based on their costs or actual cost to the business. And then, of course, for the assets, they would deduct depreciation from the initial cost, and that would produce the book value of each asset. Okay. Now let's move on to the important part of this chapter, the main topic, stock valuation methods. Now, stock valuation methods are many, but the ones that we are focusing on for the purpose of this, for the scope of this course, are 3 main methods. One we have already covered in a previous chapter, which is the valuation by comparables. That includes ratios and multiples, and we've covered that, I believe, in chapter 4, if you remember. We did cover it from the perspective of the financial manager, so internally, where the company uses or applies these ratios to measure the company's performance. Okay? And I mentioned to you at the time that these same tools could also be used by potential investors looking to invest in a business. Okay, so they could be used by external users to evaluate the business and decide whether they want to invest in that business or not. Okay, so we could call this method number 1, which we're not going to cover in detail in this lecture. We have already covered that previously. We're going to focus on the other 2 methods. The second one is called intrinsic value. This is calculated by figuring out the present value of future cash payoffs from a stock or other security. And then finally, the third method, which is called the dividend discount model. And for this one, we discount cash flows that are expected to be generated by a stock. Okay, and we'll want to find their present values of these or all of these for all of these cash flows, and based on that we can determine the stock price today. All right. Now here is the intrinsic value method. Okay, this is the formula to calculate the intrinsic value. So V0 here stands for the intrinsic value of the share, and that equals dividends that are expected per share at the end of the year, plus P1, which stands for the predicted stock price in the first year, and we divide that by a discount factor. Okay, 1 plus R, and R here stands for the discount rate for the stock's expected cash flows. This is the either can be given in the question as the discount rate or the expected rate of return or the required rate of return, and so on. All right. Here we'll see an example. The example says, what is the intrinsic value of a share of stock if expected dividends are $3 per share and the expected price in 1 year is $81 per share? Assume a discount rate of 12%. Okay. So this is a stock that is expected to pay $3 in dividends. Okay, so this $3 will go here, and then it's expected to reach this price by the end of the year. So this will go here, and then the discount rate is 12%, which is going to be placed here. Okay. So we apply the formula. The dividends are $3, okay, plus $81. This is the expected price, and then we divide that by 1 plus 12%, and that would give us the intrinsic value for this stock to be $75. Now, what does that mean in practical terms? It means that if you have a certain stock that is expected to pay a $3 dividend and is expected to reach $81 in price by the end of the year, and you require 12% as a return, you should not pay more than $75 to purchase the stock. So if you determine the intrinsic value to be $75 and you check the stock price and you find it to be lower than 75, let's say $70 for example, that means this is a undervalued stock and could potentially be an attractive investment opportunity for you. But if you figure out the intrinsic value to be $75 and then you check the stock price and you find it to be, let's say, $86, that means the stock is overvalued and you should not acquire the stock at this price level. Okay, moving on. We also need to learn how to calculate the expected return on a stock investment, and that is calculated by the following formula. What does it represent? It represents the percentage yield that an investor forecasts from a specific investment over a set period of time. That's why it's also called the holding period return, HPR, because it does not really take into consideration how long the investor have kept the stock for. Okay, so someone who invested over in a stock for 1 year or for 10 years, this specific formula does not really differentiate. And of course, we know that, for example, if you calculate your expected return and you found it to be 10%, for example, but you generated that over 10 years, that's not really great. But if you manage to someone else who generated the same return within 1 year, that's definitely better. So that's one of the main problems with this specific method, is that it does not really takes the investment horizon, as we call it, into consideration. Okay, but it is really important because it shows us the two main drivers of returns for stock investments. As you can see, the formula covers the dividends and the change in price, or we call it the capital gain, that is generated for the stock. So here we have dividends, price of sale, and the price of buying the stock divided by the price of buying the stock. Okay, that gives us the expected return, and it should be always expressed in a percentage. All right, here's an example. It says, using the prior example, meaning the previous one that we talked about, which had a dividend of $3 and a selling price of $81 per share. Okay, so using the prior example, what is the expected return, assuming the stock price started the year at $75? So this is P0. 0. Okay. Now substituting in the formula, R would be $3, which is the dividend, plus P1, $81, minus P0, which is $75, all divided by P0 again, which is $75. And that gives us 0.12, which again, as I said, it should be expressed in a percentage, so that's 12%. And because the formula covers two components or two parts of the returns or the drivers of returns for stock investment, we can break it down. Okay, so we can split the formula into two components. One component will be used to calculate the dividend yield, and the other part or the other component is used to calculate the capital yield or capital appreciation. Okay, how do we do that? Because all of the terms in the formula are divided by the same number, we can split this in half and distribute this over the two fractions, just like you see right here. So here is the dividend yield, right here, this component, which is calculated by dividing the expected dividend by the costs or the buying price of the stock, and then the capital appreciation component right here, which is calculated by dividing the difference in price between the buying price of the share and the selling price by the cost or the buying price of the share. Okay. If you calculate each one separately and then add them together, you would still get your R or your expected return. Okay, so you can either use this or the previous formula. It doesn't really matter, but sometimes you're going to have to use this because sometimes the question might only ask you for the dividend yield or might only ask you for the capital appreciation, just like you will see in the exercises of this chapter later. Here is an example. It says using the prior example, again, the one where the dividends were $3 and P1 was $81. Okay, what is the expected dividend yield and capital gain? So now notice now that this example is specifically asking you to calculate each one of these components separately. Okay, so we can simply do this. So dividends 1 or div 1, which is $3, divided by P0, which is $75, plus the difference in price. Let me just put the denotation here just so you can remember. P1 and this is P0. This is P0 and this is div 1. Okay, and this is P0 again. Okay. Now calculating each one separately, we can see that this investor, or for this investment in particular, the dividend yield is 0.04, which is 4%, and the capital appreciation yield is 8%. Okay, putting them both together, we get the same answer, which is 12%. So to answer the question, the expected dividend yield is 4% and the expected capital gain is 8%. Now moving on to another very important tool that is used to value common stock, which is the dividend discount model. Okay, which is the third method that we talked about. The dividend discount model is a discounted cash flow model which states that today's stock price equals the present value of all expected future dividends, okay, plus the cash proceeds that would be generated by selling the stock. Okay, and here is the formula for that. The price of a stock today, P0, is going to equal the expected dividend by the end of the year, div 1, discounted for 1 year, plus the dividends expected in 2 years, discounted for 2 years, and so on, all the way until you get to the last dividend that you expect to collect, let's say maybe in 5 years or so, and plus the price that you expect to sell the stock for in that same year, discounted for or by a factor of how many years that you've been holding the stock for. Okay, so T here in the formula, because this really doesn't matter, it depends on how many years you are given in the question, then you're going to have to substitute T for that number of years. So if it was 5, you're going to put 5. If it was 10, you're going to put 10, and so on. Here's an example. Current forecasts are for XYZ company to pay dividends of $3, $3.24, and $3.50 over the next 3 years, respectively. At the end of 3 years, you anticipate selling your stock at a market price of $94.48. What is the price of the stock given a 12% expected return? So here they are also giving you R, which you're going to be using for your discount factors. Okay? All right. So now, applying the formula, P0 or the present value, it's the same because we are basically just calculating the present value of these cash flows. The amount that is going to be, or we expect to receive by the end of the year is here, which is the first year's dividend, discounted for 1 year. So 1 plus R to the power of 1, plus the dividend that we expect to get by the end of the second year, discounted for 2 years. So 1 plus R to the power of 2. And finally, for the third year, we expect to get 2 cash flows, one from the dividends and one from selling the stock. Okay, so we add them together and then we divide by 1 plus R to the power of 3. Okay, so if we want to show this on a timeline, it would look something like this. 0, 1, 2, 3. Okay, we want to find what's the present value right now for this stock that we expect to pay us $3 here, and then $3.24 at the end of the second year, and then $3.50 by the end of the third year, plus $94.48. Okay? And all we're doing here is that we're discounting these amounts and finding their present values. All right? Okay. If we forecast no growth and plan to hold out the stock indefinitely, we will then value the stock just like we used to calculate perpetuities. If you remember in the chapter 5, when we were talking about time value of money, we learned the formula to calculate a perpetuity. So if the dividends of the stock are fixed, we know that they are fixed, or we expect them to be fixed in dollar terms, then we can calculate it using this special case formula, where the price of the stock today is going to equal the expected dividend that we expect by the end of the year, divided by R, which is the required rate of return. Okay. We have also another special case that derives from this, is that we can also do the same. We can also calculate the value of the stock today, or the price of the stock today, by dividing the earnings per share by R instead of dividing the dividends. And this is only done if the payout ratio of the company is 100%. That means that if the company that we are trying to evaluate their stock pays out all of their earnings to the investors in the form of dividends. Okay, so all of the earnings per share goes directly to the investors. Then if we have that special case, then we can, instead of dividing the dividends by R, we can just divide the earnings per share by R. Okay. Another scenario is which is more common, that we can apply when we know that the dividend is expected to grow at a certain rate, which is the most common scenario, because dividends typically for companies, they don't stay the same for a very long period. Typically, they grow over time, okay? And that growth might be constant and it might not be constant, okay? So that if the growth rate is constant, we can apply what's called the Gordon model or the Gordon growth model or the constant growth model, okay? This is a version of the dividend growth model that we just covered, in which the dividends are expected to grow at a constant rate, okay? Meaning that, for example, the company next year is expected to pay $1 in dividends, and then maybe the next year they're going to pay $2 and then $3 and so on. Okay, so there's a certain growth rate that we expect the dividend to grow by over the years. Okay, and the formula is as follows. The price of the stock today, or the value of the stock today, is going to equal the dividend that we expect to get by the end of the year divided by the expected rate of return, R, minus G, which stands for the growth rate. Okay? Now, the thing is, for exercises, you're going to see that you're not always going to be given all of these and you are required to figure out the price, right? Sometimes you will be given the price and one of these values might be missing. Any one of these three. Okay? So as long as you have a good handle on your mathematical skills, you should be able to play around with this formula, and for whatever missing value, you can still find it, as long as you have only one missing value. Okay? Whether it was the growth rate or the required return or the dividends. As long as you have all of the variables given to you except for one. If you have more than one missing, then it's not going to be possible to calculate. Okay, so here this is what this says to you. Given any combination of variables in the equation, you can solve for the unknown variable. Here's an example. What is the value of a stock that expects to pay a 74-cent dividend next year and then increases the dividend at a rate of 5% per year? So this is G. Indefinitely. Assume a 7.8% expected return. So this is R. Okay? So now we have div 1, we have G, and we have R. So we can use the constant growth model to figure out the value of this stock. Okay, so P0 is going to equal div 1 divided by R minus G. We substitute for all the variables that we know, so 74 cents for the dividends, divided by 0.078, which is the 7.8% R, minus 5%, 0.05, which is the 5%, the growth rate. And that will give us a fair value for the stock of $26.43. Okay, straightforward. Okay. Now, if a firm elects to pay a lower dividend and reinvests the funds, the stock price may increase because future dividends may be higher. Now, this goes back to the point I mentioned at the beginning of this lecture, where the company generates profits normally, okay, and then the financial management of the company may decide what portion of the profits they want to give back to the investors in the form of dividends, and what portion or how much of the profits they want to reinvest in the business in the form of retained earnings. Okay. Now, the portion of the profits that will go to the investors in the form of dividends is called a payout ratio. Okay? Where the portion is going to be kept in the business in the form of retained earnings is called the plowback ratio. All right. For example, a company may decide to give or to have a payout ratio of 50% and a plowback ratio of 50%. So in this case, that means that they're going to take their profits and they're going to give half of it to the investors in the form of dividends, and the other half they're going to reinvest in the business to fund future investments. Okay? So this is basically it right here. The payout ratio is the fraction of earnings paid out to the investors in the form of dividends, and the plowback ratio is the fraction of earnings retained by the firm. Okay? Which takes us to the sustainable growth rate. When the more the company retains, or the bigger the portion of their profits they reinvest in the business, typically the higher the growth rate of the company's future dividends. Okay? So a sustainable growth rate is the firm's growth rate if it plows back a constant fraction of earnings, maintaining a constant return on equity, and keeps its debt ratio constant. Okay? Growth can be derived from applying the return on equity to the percentage of earnings plowed back into operations. Remember the constant growth model that we covered. It had G as one of its components. Now, G could be given directly in the question most of the time, but sometimes if it's not given in the question, you might be given the return on equity and the plowback ratio instead. Okay? Or you might be given the return on equity and the payout ratio, and from the payout ratio you're going to have to calculate the plowback ratio and use it to substitute in this formula to find G. Okay? If you are given the return on equity and the plowback ratio, just multiply them and you will get G. If you don't get the plowback ratio, instead you get the payout ratio. Okay? Just know that the relationship between the payout ratio and the plowback ratio is always 1 minus the plowback ratio. Why? Because there's no other option. The company would take their profits and they would either pay it back to the investors in the form of dividends or reinvest it in the business. So if we know that the company, for example, pays out 60% as dividends, that automatically means that the remaining 40% is going to be reinvested back into the business. Okay? So you could always remember this. It's not given here in the slides, but it should be known as a base for your future exercise solving. Okay. Present value of growth opportunities, PVGO, is calculated by the net present value of a firm's future investments. Okay, we're going to see how that plays out shortly, but this is also another important metric that you can calculate as well. You might be asked. I did not see any questions in your exercises that covers this specific bit, but it's easy to calculate. Okay. Here is an example. Aqua America has a return on equity of 12.5% and a book value per share of $9.86. It intends to plow back 40% of its earnings and the opportunity cost of capital is 7.8%. What is the stock price? Okay. Now here, we want to find the stock price using the Gordon model, right? Which is P0 equals div1 divided by R minus G. But we do have a problem here. We don't have G, right? So we're going to need to calculate G, which is the growth rate. Okay? And the formula for the growth rate is G equals, just as we have learned in the previous slide, return on equity multiplied by blowback ratio. Okay? The other thing is that we are given the return on equity and we are given the blowback ratio, right? But we also don't know the dividends of the company, right? So first thing you might want to do here is just calculate the growth rate, which is going to be the return on equity multiplied by the blowback ratio, just like you see here. So we have 40% multiplied by 12.5%, and that gives us G, which is 5%. Okay. But we want to determine the dividends as well, and we're not given the dividends. However, we are given the stock price, the book value right here, the book value per share to be $9.86, and we know the return on equity. So from those two figures, okay, we can figure out the earnings per share, and then we take that earnings per share figure and multiply it by the payout ratio. Again, here we are not given the payout ratio, but we are given the blowback ratio. And remember what I said, that the payout ratio is always going to be one minus the blowback ratio. Okay, so since we know that the blowback ratio is 40%, then the payout ratio is going to be how much? 60%. Okay, so we found G, and we found the earnings per share, the book value per share multiplied by the return on equity. That gives us an earnings per share of $1.23 approximately. We take that $1.23 and we multiply it by 60% to figure out how much of those earnings per share are actually going to be paid out to the investors in the form of dividends. So we get 74 cents. Now we can go to our original formula, to the Gordon model, and we take the 74 cents divided by R minus G. R is 7.8%. Minus G, we calculated from here, 5%, and we get the stock price of $26.43. Okay. The example continues here. If Aqua America decides not to reinvest any earnings, okay, meaning that they're going to pay out all of their earnings or all of their profits to the investors in a form of dividends. Okay, so the blowback ratio is going to be 0, and the payout ratio is going to be 100%. They're going to pay out all of the profits back to the investors. What is the value of the stock, and what is the present value of growth opportunities of the firm that is lost? Okay, going back to our original calculation, we already know the earnings per share, right? Now, the earnings per share is $1.23 approximately. This is all going to go to the investors in the form of dividends. So now this is going to be our expected dividend by the end of the year. We go back to the Gordon model. We use the $1.23 as the dividend, and we divide by R only, no G, because there will be no growth, because the company is not going to reinvest any of its earnings back into the business. Okay? There will be zero growth, no growth. So we go back to the formula that we talked about earlier, where we have constant dividends, no growth expected. Okay, and that gives us a price of stock of $15.81. Now, how do we calculate the present value of growth opportunities? Is going to be the difference between the price without growth and the price we calculated earlier with a 5% growth expected in the dividends. Okay, so $26.43 minus $15.81, that gives us $10.62. Here is another example. The numbers here are not clear, but I'm gonna write down the calculations for you. Don't worry about that. It says our company forecasts to pay a $5 dividend next year, which represents 100% of its earnings. This will provide investors with a 12% expected return. Instead, we decide to plow back 40% of the earnings at the firm's current return on equity of 20%. What is the value of the stock before and after the blowback decision? Okay, so we have two scenarios here. One scenario where the company is going to pay out all of its earnings back to the investors. Okay, so we'll have no growth for the dividends. And the other scenario where we're going to change our policy and blow back 40% of our earnings and reinvest that back into the business. Okay, so first let's do the no growth scenario. If there was no growth, P0 is going to be div 1 divided by R. Okay, and that's going to be the $5 right here, $5 divided by R, which is 12%. Okay, so 0.12. Using a calculator, $5 divided by 0.12, and that's going to be $41.67. Okay, so that's the fair price of the stock under the no assumption. The other assumption, or the other scenario, we're going to blow back 40% of the earnings into the business. So we need to first calculate G, which is the growth rate, which is going to be the blowback ratio multiplied by the return on equity. The blowback ratio is 40%, and the return on equity is 20%. Okay, so G is going to be 20% multiplied by 40%. 0.2 multiplied by 0.4, that's 8%. Okay. Now we go back and apply the Gordon model to find the price of the stock. It's going to be div 1 divided by R minus G. Okay. One small trick here that you're going to need to notice is that under this assumption, not all of the earnings are going to be paid back to the investors. Okay. They told us that 40% is going to be reinvested, which means that only 60% is going to be paid out in the form of dividends. Okay. Now, knowing that the $5 dividend was expected, under this assumption is we're only going to take 60% of that. So 5 multiplied by 0.6, that's $3 only. So this is the amount that the investors should expect to get in the form of dividends. Okay. Divided by R, which is 12%, minus G, which we just calculated to be 8%. Okay. Now we run the numbers on a calculator. 3 divided by, open a bracket, 0.12 minus 0.08, we get $75. Okay. Now notice the difference in the stock valuation under both of these scenarios. All right. Now, knowing these two numbers, we could also calculate the present value of growth opportunities. So the example continues here, and it says if the company did not blow back some earnings, the stock price would remain at $41.67, just like we have calculated here. Okay. With the blowback ratio, or with the blowback policy, the price rose to $75, which is what we have calculated right here. The difference between these two numbers, which is 75 minus $41.67, equals $33.33. And this is called the present value of growth opportunities, the PVGO. Okay? So if the example or the question have included a part or a question at the end that says what would be the present value of growth opportunities, this is how you're going to calculate it. Okay. Now, we learned how to value stocks if they had no growth. We learned how to value stocks if they had a constant growth in the dividends. Now we're going to see the third scenario where we want to value stocks with non-constant growth. So there is expectation for growth, but that growth is not constant. Okay? There's no fixed G or growth rate. All right? If we have that scenario, we're going to need to follow these steps. Okay? First, we need to set the investment horizon, year H, as future year, after which you expect the company's growth to settle down to a stable rate. Then calculate the present value of dividends from now to horizon year. Second step is to forecast the stock price at the horizon and discount it to give its present value today. Finally, sum the total present value of dividends with the present value of ending stock price at the horizon. How is that done? Similar to this formula right here. For example, if we expect the company's growth to vary in the first 3 years, for instance, we're going to take the dividends for the first year, discounted on its own by 1 year, and then the second year's dividends discounted for 2 years, and then the third year's dividends and discounted for 3 years. Okay? And then we assume that after the third year, the growth is going to settle down. It's going to become relatively constant. Okay? So for that portion, we can then apply the constant growth model. All right? To find the price at that year. And then once we find the price at that year, let's say year 3 or year 4, then we're going to have to discount it back to the present time. Okay? I'm going to show you an example shortly after the prayer time. Okay, let's see now how we can use this. Here's an example. It says, given the following earnings and dividends, an 8.5% discount rate and a perpetual growth rate of 5%, which begins in year 6. What is the value of the stock? Okay, so as you can see here, we do have some dividends that are paid out over the first 5 years with no constant growth. So the growth here is not constant. Okay, so we're going to have to discount each of these payments individually based on the year that they are expected to be received at. Okay, but then from the 6th year onwards, from year 6, we're going to assume a constant growth rate. Okay, so here the present value of the dividends between year 1 and 5, the first payment at the end of the first year, $2.85. We discount that by 1 year. Okay, 1 plus R, which is given to us here, the discount rate, 8.5%, to the power of 1, because this is going to be received at the first year. Okay, and then for the second payment, $3.14. This is the expected dividend to be received by the end of the second year. We discount it for 2 years, and so on. Okay, we discount each one individually, then we add them all up together, and we get the present value for that period of time from the first or from now until the end of the 5th year. All right, but then after the 5th year, we're going to have the dividend that was received at year 5. We're going to assume that this is going to grow by the 5% growth rate that was given to us. Okay, this is why here you see that we took that $4.17 and we multiplied it by 1 plus 5%. Okay, that means that the dividend that is expected to be received at year 6 is going to be $4.38. And then we divide that by R minus G. R being 8.5% minus the dividend growth rate of 5%. Okay, we got $125.14. Now notice that this is, if I draw this on a timeline, it's going to be something like this. Okay, this is 0, 1, 2, 3, 4, 5, 6. Okay, and here we have the payments. We're gonna write them on the top, but then for the 6th year, as we have calculated right here, we expect to get $4.38. But what we are doing here is that we're discounting all of the following dividends, assuming that they're going to have a constant growth rate. What we have done in this calculation is that we have taken all of these payments right here, we've discounted them to here, to year 5. Okay, we still gonna need, so this is the value of these dividends from the 6th year onwards at year 5. That means we're still gonna take this amount and we're gonna have to bring it back to the current time as well. And this is what we're gonna do next. So the dividends of the first 5 years that we have calculated to be $13.50, and then the constant growth period from year 6 onwards was calculated at the end of, or how much it will be by the end of the 5th year. We need to still discount it to bring it to time 0. Okay, so we discount it by 1 plus R to the power of 5. And then finding the total of these two separate discounted amounts, we reach the conclusion that the stock with the given inputs or the given details is worth $96.72. All right, I hope that this example is clear. This might be the most difficult scenario that you can imagine, but it's worth knowing in case you receive a similar example. Okay. Finally, we're going to wrap up this lecture by talking about two very important aspects: the types of analysts in stock markets. We have two main types of analysts that are involved in the stock market, and you might commonly you might have heard about these terms before, which are technical analysts and fundamental analysts. Okay, what is the difference between those two types of analysts? Well, a technical analyst is an investor who attempts to identify undervalued stocks by searching for patterns in the past stock prices. Okay? They forecast stock prices based on watching the fluctuations in historical prices. Okay? They call them wiggle watchers. So, put in simple terms, technical analysts only use the stock charts to determine whether they want to buy a certain stock or not. Okay? They simply base their analysis on the movements, the historical movements of the stock price. Whereas fundamental analysts, these are investors who attempt to find mispriced securities by analyzing fundamental information such as accounting data and business prospects. They research the value of the stock using net present value and other measurements of cash flows, similar to what we've been doing in this chapter and in chapter 4 as well, using ratio analysis and things like that. This is what the fundamental analysts do. They try to dig deep in the documents and all of the information they can find about the company itself, about the sector that it operates in, about the economy, and compile all of these information together and try to scientifically come up to a conclusion about the actual fundamental worth or the intrinsic value of a certain stock, and then determine whether they want to invest in that business or not. Okay? That's it for this chapter. I hope that you found this lecture useful. If you have any questions, as always, please feel free to write them down in the comments. And until I see you in another video, I wish you the best of luck. I wish you the best of luck in your studies and preparations for your exams. And I'll see you in the next one. Take care.